started in this industry, actually being out in it, and then about 25 years ago, left the real world and went to work for A.G. Edwards. And I started with a very simple thesis. And the simple thesis is that freight matters. As I looked at all the other transportation analysts out there, one of the things I noted was is that in addition to being good fundamental analysts on transportation stocks, they all also tended to be pretty decent, at least amateur economists, and pretty decent amateur oil analysts. And I think being an oil analyst is less important than it used to be. But that said, that's what was the difference between the people who had careers that lasted 10, 20 plus years and the people who had careers that lasted 3 years or less. So I started looking for ways to get a little wiser, a little smarter about the economy. And one of the things that jumped out at me immediately was that everybody was hyper-focused on transportation stocks as being a leading indicator. And I tried to get to the root as to why that was why that was the case. So in the interim, a lot has changed. This is a picture from back then. There's a couple of things you'll notice. You're going to say, what the hell is CNN FN? Doesn't exist anymore. What the hell is A.G. Edwards? It was a great firm until Wachovia bought it right before they went bankrupt. The Dow's 11,000, the Nasdaq's 3,500. Their stocks are still being traded in transactions. And yes, I have hair. That's really a toupee, you're thinking. I know it's not. It's actually my real hair. Come on, it's a come over. No, it's not. But that said, in the ensuing time, a lot has changed. But again and again, I've continued to repeat this theme. This theme was that you can find out just about everything you want to know, need to know about what's going to happen in the economy by simply looking at freight flow first. You've heard me say it once, twice, 3, 4, 5 times if you've been here before, but I will say it again. Transportation stocks themselves are not somehow omniscient or prescient. Transportation stocks appear to predict the rest of the market, appear to predict the economy because they're reflective of the underlying goods flow. The underlying goods flow is the economy. You got to ship lumber in order to build a house, period. You got to air freight a semiconductor in order to build a smartphone. That's the way it works. That said, most transportation companies are extremely asset intensive. And the more asset intensive you are, the more changes in your asset utilization are reflected in your margins and your operating profit. If you're extraordinarily asset intensive, a small change up or down in your asset utilization will result in a big change in your operating profit. And as a result, guess what? Operating profit goes up a lot or down a lot. What happens to your stock price? Well, it goes up and down as a result. That the stocks seem to be omniscient is simply symptomatic of the underlying goods flow. And the crazy part about it is I can't keep saying the same damn thing and everybody seems to be interested. And I'm not really saying anything different other than updating the data I'm talking about. What's also crazy is it's allowed me pretty successfully to navigate and be bullish when I should be bullish and bearish when I should be bearish. And again and again, I'm reminded of the story of the 2 guys that are out in the woods and a grizzly bear is running towards them and one of them stops. You've heard it all. You've all heard this. And starts tying his shoes. And the guy's like, why are you tying your shoes? You're no way you're gonna outrun the grizzly bear. And the guy goes, I don't need to outrun the grizzly bear. I need to outrun you. And that's true in the financial markets. I don't have to be smarter than everyone. I just need to be, by a large margin, I just need to be a little bit faster, a little bit earlier, and away we go. One of my favorite stories to tell is back when I was at A.G. Edwards, I was on the investment strategy committee. And in early, I want to say March, April '06, I started seeing lumber shipments fall. You all started to feel your demand start to wane. And by the end of '06, I was clearly the most bearish person on the investment strategy committee. And the somewhat ironically, the chief economist, he had a PhD in economics, was the most bullish person. And one day he got really flummoxed with me in late '06 and said, you know what your problem is? And I go, He's like, I go, I have a mother-in-law. And she usually keeps me apprised of these issues, but no, Gary, what's my problem? And he said, it's the blue car syndrome. I go, what are you talking about? I skipped class that day. And he goes, the blue car syndrome. You buy a blue car and then you notice all the other blue cars on the street. I still not following you, Gary. All you do is look at freight, and I go, that's not fair. I look at a lot more freight, but it's where I start, and it's where I come back to because it works. The crazy part about this whole experience is not only does the market want to know, but the people who are actually in freight want to know. Because Fred Smith may know about air freight, but he may not necessarily know that much about rail freight. Hunter Harrison and Matt Rose, they know about rail freight, but they don't necessarily know anything about air freight or international cargo bulk. So together, all of them want to know about each other's modes because they get it. They understand it matters. And even people that are tangential to the industry, if you've not read Boone Pickens' book, I guarantee you it's well worth a read. He is one of the most colorful, direct, great people on the planet. His book is called The First Billion is the Hardest. Okay. That said, I actually met him in the early 90s when he had just gotten divorced the first time, and he had to give his wife half his net worth, which was $37 million. A year later, he founded Mesa Petroleum. 5 years later, he was worth $1 billion, and he says to me, so, that worked out well for her. That said, he is constantly very interested in that data. When you look throughout the industry, that's what you see. So let's make sure we start on the same page. That's what you're going to get. That's what I do. First of all, the 2009 through 2014 period was the first industrial-led recovery we've had in the United States since when? Since 1961. Every other recovery post-1961 was consumer-led, not this one. What happened was very, very interesting. We developed fracking. We've been fracking, going down into wells and setting off controlled explosions to free up the gum and the tar, the wax, for 80 plus years. But that concept of going down and going horizontal and then setting off controlled hydraulic explosions and forcing sand and ceramic propellant beads with a little bit of emulsifiers into those cracks so that this entire layer of source rock is turned into a big sponge full of cracks, and then you let the 10,000, 15,000 feet of earth on top of it press it, and meanwhile you suck all the oil and gas out of it, is a new concept. It's an American technology. And when we had the epiphany moment in February of '09 was when they made the leap that resulted in what we have today. February of '09 in the Eagle Ford Shale, at the very depth of the financial markets, we changed the oil and gas industry forever. What was previously resources that we couldn't get to, unattainable, became suddenly attainable. We have begun to exploit them here. They're still completely unexploited around the globe. China sits on top of what is the largest layer of gas source rock in the world, and their natural gas prices are much higher than ours because they don't have fracking. Oil market price is driven by the nominal cost of production, and we keep bringing it down. The amount we produce in a fracked well doubled, then tripled, then quadrupled, and it's now 6, 8, 10-fold, depending on the well, of what it was if we tried to do it in 2010, 2011. We keep improving that technology and what we're able to get it. As a result, we as a country have gone from being a net importer, the world's largest net importer of oil, to being a net exporter, where we now produce more oil than Saudi Arabia by a factor of Kuwait. That's how much bigger than Saudi Arabia we are. And it doesn't matter what OPEC does or doesn't do, how badly the Iranians misbehave or don't, what happens in Venezuela. The price of the oil doesn't skyrocket like it used to just because some dictator or despot in a foreign country is doing something that we don't like or that's disagreeable to us or the rest of the world. It doesn't matter anymore because we make so damn much oil, it doesn't matter. And natural gas is the same way. It's basically free. The cost of it is basically the cost of transportation. The consumer economy, and that drove the industrial recovery. We built 8 new refineries. We built 22 polyresin plastic production facilities, and the rest of the surrounding industrial economy exploded. We had a mild consumer industrial recession in 2015 and the first 3 quarters of 16 as oil dropped down in price, and it was below that nominal cost of production, so we stopped. We had drilled uncompleted wells, but that's since come back and we're off to the races again. The consumer economy. The consumer economy was in a no growth, slow growth mode throughout the entire Obama administration. I'm sorry, those are the facts. Obama did some really very interesting and good things for the country as president. And I didn't vote for him either time, but I will admit there are some things he did that were good. However, that said, consumer growth averaged less than 1% a year. It was really just over 0.5% a year. It was the growth in consumer spending coming out of the 09 recession through 16. That's not a recovery. Eventually, it did start to recover. Demographics and economics finally took over. What happened? We had people say that the millennials are never going to move out of the basement. They're never going to move out of basement. But indeed, they are beginning to. And the reason is very simple. They are getting married later in life. Now, why didn't we understand that? Well, I don't know why, because I got married later than my parents, who got married later than my grandparents. The longer the life expectancy and the higher the rates of education, the later in life you tend to get married. Not always, but as a general rule. So guess what? We have longer life expectancy and more people going into and graduating from college, and lo and behold, they wait a little longer to get married. And nothing drives consumer spending like household formation. And everybody in this room understands it. As a bachelor, I can live on a mattress in the corner of a room. And I'm fine. It's all good. But get yourself a missus, and that's not gonna work. I remember the experience of having everything moved, and everything that had been in my bachelor apartment got moved into the house my wife and I were moving into. Everything except a coffee table. I did have a nice coffee table, evidently. Everything else in my entire bachelor apartment got marked second bedroom. And that's where it ended up. It ended up in the spare bedroom in our new house. Technology economy. The U.S. continues to be the leader in the design, development, production of hardware and software globally of technology. And guess what? This is the technology era. It has its own rhythm. And it has been white hot for a long time. And if you don't believe it, go to San Francisco and try to get a hotel room that's bigger than just a couple of these blocks here on this stage. That's big, slightly bigger than the bed that doesn't have bed bugs for less than $500 a night. It's ridiculous how white hot Northern California, Seattle, et cetera are. And that's great. And we're the world leaders. It also distorts the trade balance. There's something that has to be understood. And this is one of the things that's just, it's a piece of sand in my oyster. It's in my craw. 17%, last year, 17% of the trade deficit we reported as a country was due to smartphones. Apple, the dominant player in that business in our country, is an American company. There's approximately $370 to $380 worth of parts and pieces and assembly cost in a new iPhone. $10 of that cost is Chinese assembly. All the parts and pieces come from elsewhere. They come from Taiwan, they come from Japan, they come from here, they come from South Korea, they come from Singapore. They're all imported to Shanghai. I'm gonna talk about that in a minute. Then the Chinese, through the Foxconn assembly plants, assemble it. Yet so China runs a trade deficit with the rest of Asia, but a trade surplus with us. And when we get that iPhone shipped over to us, is it shipped at the $400 manufactured cost? Is it shipped at the wholesale cost of $800? It's miscalculated. The amount of trade deficit that we have with China should be $10 per iPhone, not $400 to $800, depending on how it's calculated, by whom, and one, and two, what is the value created? The reason that $400 piece of cost of goods manufactured and delivered is worth $800 at the wholesale and $1,200 at the retail is because of an American company's ingenuity, engineering, employees, shareholders, investments. So is that really a trade deficit? I don't think so. And we talked about this last time I was here. I'll talk about it briefly again. Technology has killed inflation. It is DOA for the foreseeable future, and we want to Q&A, argue about it later, we can do so. I talked about it last year. I showed you all the data. That's what's happened to inflation since Moore's Law. Period. I'm not going to repeat it. If you want to argue with me about it, I'm happy to do so. I'll list out the reason, but the bottom line is that technology has killed inflation. Federal Reserve's mandate, they cut rates yesterday. Everybody says, oh, are they going to do it again? Is it because they're, I don't know. Here's the bottom line is forget all of the noise and go back to the beginning. What's their charter? They're supposed to promote maximum employment. I think they're doing a pretty good job of that. So to the extent they actually have any input or control on it. They're supposed to promote stable prices. Pricing is pretty stable unless it's government subsidized. If you go back and look at what has had inflation, cost of higher education and the cost of medicine and medical care, which are all subsidized by the government, you've seen pretty enormous rates of inflation in those, everything else not. And they're supposed to promote moderate long-term interest rates. The 10-year treasury is 2.06 as of the last time I checked the yield this morning. I think that's pretty good. So, simple things. What we all need to do, we need to challenge conventional wisdom again and again and again. We fall into traps, and I'm going to talk about those. We need to challenge conventional. We need to focus on what matters and ignore what doesn't. I've talked about it before. Consumer sentiment doesn't matter. It's one example. There's thousands of them. I don't care what Kim Kardashian does. I really don't. I don't. It doesn't change how much money I have to report to the IRS. It doesn't change how much money is in my account at the end of the day. It doesn't change how much I can love and receive love from the people that I care about in my life. It doesn't change how fast or pretty my car is. It doesn't change how much hair I grow on my head. I don't care. Or grow out of my ears and nose. Focus on what matters. Imagine what's possible. One of the most perfect pieces of advice I ever received was from my mentor, the first person I trained under at A.G. Edwards. God bless John Beerbussy. He said the long-term challenge in being a good analyst is that you have to constantly apply the proper level of skepticism without ever becoming a cynic. And I think that's actually the challenge for all of us. You have to believe in something in order to invest in it. You have to believe in something in order to spend a lot of time to get it to develop. And there's a lot of things that we invest in, our money and our time in, that don't look like they'll ever amount to anything in the beginning, but they do eventually, but it just takes time. My youngest son, when he was in 6th and 7th grade, was the smallest boy in his class. But he had been doing karate and judo and taekwondo and everything to try and be able to defend himself. And then he discovered wrestling. And he committed himself to wrestling. And he wrestled varsity all 4 years in high school. He was a collegiate wrestler, just graduated from University of Wisconsin-Whitewater. And now at 5'11" and walking around weight 185 pounds, he's the last guy you want to pick a fight with. But he invested, to look at him when he was 6th or 7th grade, you'd have been like, yeah, right. But today, fast forward the tape, 10 years of working out 6 days a week, twice a day, and following a conscious diet, guess what? He's the guy who can grab the 250-pound linebacker by the triceps, squeeze it hard, and say, you're a drunk, and I think you owe that woman an apology. Have the guy say, yeah, who's going to make me? 15 seconds later, he's got him in a chokehold on the floor saying, that'd be me. And about the apology before you lose consciousness. You have to imagine what's possible in order to create wealth in any and all parts of your life. How do you challenge conventional wisdom? Technology is capable of killing inflation, but it's also capable of magnifying and distorting media's message. And remember, media's message, you heard me say it before, but it bears repeating. Media's message is be afraid. It's hyperbole. Here we are, business section of the New York Times. The business section of the New York Times is a picture of flooding This is biblical proportion. Nothing like this has ever been seen. I think Noah might feel a little differently, but okay. Nothing? Okay, really? That said, technology allows them to exaggerate and practice that kind of stuff. They want us to be afraid. It's not about being afraid. All life involves risks. Accept it, move on. And fake news is promulgated more easily. The New York Times and the Wall Street Journal may be some of the most credible sources of information that we have in print today. They require reporters to verify, double check sources. They have people who are fact checkers, that's all they do is double check to make sure that the numbers, that the sources are valid, but they still get it wrong. And people that put stuff on the internet for free, all it involves is a little bit of their time, can make up the most ridiculous things in the world. So how do you guard yourself against that? I highly recommend that you look at all of the data and judge it carefully, because there's ever more data available. And as you look at ever more data, critical thought becomes more valuable. And having more and more data means that getting to the right, asking the right question is ever more valuable to getting the right answer. You have to ignore flawed reasoning, and let me walk you through how you do that. I will tell you, highly encourage you to go to Wikipedia, type in cognitive biases, and there's a list of them. Cognitive biases are the way our human brains think and fall victim to. And we all do it, whether we want to or not. So as you're looking at this data, you have to understand what the flaws are in operating a human brain and figure out how to navigate around it. So what you do is you say, look, some simple things. The best example of this, what I'm going to call automating the hot hand of survivors on a well-traveled road. Everybody talks about the S&P, the Dow, the NASDAQ, but here's what happens. The Dow Jones adds people who do well and eliminates companies who don't. Oh, but if you invest in the index, you're a passive investor. No, you're not, because the person deciding who gets added to the S&P and subtracted from the S&P is making that decision for you. We have a bias as human beings. When we automate a system, we tend to believe that the output of that automated calculation is correct. And we will follow the conclusion it provides us, even when we can step back and objectively go, I don't think that's actually right. I don't think that's actually true. We'll still do the wrong thing because the automated system told us. We believe that the guy who just won the lottery will win the lottery again, that somebody who's been successful will be successful in their next operation. That's not necessarily true. We miscalculate the time to go from point A to point B. If you go over a route again and again, you will think it takes less time than navigating a route you've never gone before, even if the shortcut is actually shorter. These are all biases that are built into our biochemical brain, but you have to be aware of them in order to be guarded against them. You've probably heard me say this before. It's like magic tricks. If you don't know how I do it, it's magic. If you understand, it's just a trick. And you can look at it and go, okay, yeah, I got that. That makes sense. And I'm not going to ignore it. We appeal to authority or ignorance. One of my favorite of all time is my grandmother was a nurse. When my paternal grandmother was a nurse. And after she passed away, we were cleaning out her house, and I found a stack of old nursing magazines from the 1940s, 1950s. And there was an ad in it of a pregnant woman smoking a cigarette. Forget 4 out of 5 dentists chewed Trident or some gum. This thing said that 8 out of 10 obstetricians preferred the smooth taste of Camels. Well, if they're an obstetrician, and I'm pregnant, that must be the cigarette I should smoke. That's an appeal to authority. That's ridiculous. But we see that again and again and again. So when you see it, you go, okay, yeah, right, whatever. I don't care. We also have appeal to ignorance. I can't prove that aliens don't exist, therefore they must. What? That doesn't make sense. But it's part of the hardwired cognitive problem. We have we have a confirmation bias, and we have a self-serving hindsight bias. So what we see is what we just saw, the recency bias, has to be the right thing, has to be relevant. We look around for things that agree with us and cater onto that, latch onto that data because it agrees with us quicker than we do stuff that disagrees with us. Stop it. Don't do that. You don't ever develop your thought. You don't ever develop your point of view. You don't ever grow if you just look around for things that agree with you. I read the New York Times. I read the Atlantic Monthly. I read the Wall Street Journal. I read the Economist. I read National Review. I don't agree with a lot of the stuff that's in the New York Times, but I want to know what's going on. I listen to the Democratic debates, not because I like Bernie Sanders or Elizabeth Warren, but because I want to know what they're saying. And it's the only way you continue to challenge. We self-serve. Well, you know, if I had known about that, I should have known about that. Hindsight, I should have known about that. In hindsight, you go, well, I should have known. But the truth of the matter is that you only can see it in hindsight. At the time, there's no way you could have predicted what was going to happen. We anchor. If I say pick a number between 1 and 100, like 10, 1 to 2 standard deviations of you will come up with a number less than 50. Because I say 1 to 100, like a number like 10, I've anchored you to a low number. It's the way we're wired. Everybody says you've got to be a passive investor in the market in order to active managers. Everybody's doing it. That must make sense. No, it doesn't. Everybody used to dance disco and wear pantsuits and bell bottoms. Some still do. We beg loaded questions. I love this. And this is New York Times. I was loving this. We beg loaded questions. We beg the question. Backed by 2 prominent women, General denies sexual assault. Well, then he must be guilty. Otherwise, I would have never asked the question. Really? He may be horrible. He may be the worst sexual offender of all time. He may also be completely innocent, but in a position of power in which somebody wanted to try to bring him down because they didn't like what he decided to what he thought was the way things should be done, and his behavior was actually rational and the right thing to do. Do you still beat your wife is essentially the question. Actually, the environmentalists are really, really good at this. Carbon emissions have gone up and the average temperature of the earth has gone up. Therefore, it makes sense. Therefore, we have global warming. Well, they may be right, but there's no proven correlation between the two. They assert there is, but they haven't mathematically or scientifically proven it yet. Not saying they're wrong, but a lot of people do that. Well, you said something hateful. You disagreed with someone of color. Therefore, and being hateful to someone of color is racist. Therefore, you're a racist. No, I had a disagreement with someone who was Hispanic. I have disagreements with people who are white. I have disagreements with people who are male, female. My girlfriend's from Zambia. I'm not a racist, but I disagree with people based upon the merit of their argument, based upon the merit of what they think versus what I think, in part because I think I'm trying to convince them of my view, and in part because I'm testing my own view. It doesn't make me a racist, does it? But we do that all the time. It happens everywhere. Non sequitur. We see this again and again where people say, I was doing this, and then out of left field, they come out with something completely different or to distract you. It happens again and again. Straw man, slippery slope. Senator White wants to limit defense spending. Now, I don't know about you, but I can't believe that Senator White wants to completely destroy our defenses and leave us open to terrorists and attacks from other countries. Straw man. Well, if we raise taxes even a little bit, the next thing you know, we'll be a communist country. We'll have to give all the government all of our taxes. It's a slippery slope. If I have a beer, next thing you know, I'll be a heroin addict. No, that's not quite how it works. But we hear arguments like that again and again and again, and you have to, when you read them, you know, I'm just in front of the Wall Street Journal. Sanders, Warren fight back against moderates in debate. Well, of course, it's a debate. And they're not moderates. So of course they did that. Doesn't make any sense. So what can you trust? You can trust hard data from reliable sources. And we all know what they are because we experience them and we know who you can and can't over time. Because why? Because it's reliable, it's reliable, it's reliable. And so you know. As I said, read points of view from other sides. It's how we grow and develop our points of reasoning in our mind. Ignore the hyperbole. Let's follow the freight. So what about freight? I've worked a lot with Cass. Cass is the largest provider of third-party freight bill payment services in the United States. They pay $26 billion worth of freight bills. I think that's a statistically significant number. They pay freight bills in a host of different modes. Some of it's rail, some of it's LTL, some of it's truckload, dry van, reefer, flatbed, some of it's parcel, barge, air freight, you name it. This is the number of shipments they've paid freight bills on. You can see the industrial recession, mini recession in 15 and 16. You can see the boom we had in 18, and it's now negative for 7 months in a row. Does it mean we're gonna have a recession? No, but I knew it when I was writing the most recent month's report. This indicates, it raises the risk. It means you should be aware that we could be headed into an economic contraction. Oh my God. I got quoted in the USA Today. It was in the Washington Post. I got asked to be on CNBC. Everybody, oh, we could have a recession. Oh my son, we have a recession. Sky is falling. The press loves that. Does it mean we're gonna have one? Not necessarily. It just raises the risk. If I look at Cass versus the GDP, it's been a pretty decent tracking of it all along the way. There are problems with the way we calculate GDP. I've actually written a series of articles, you can find them on FreightWaves, about the problems you have with the way we calculate GDP, because the way we calculate GDP was developed in 1937, and there have been some changes in our economy since 1937. So that old methodology doesn't work. All increases in inventory are calculated as an increase in GDP. Well, in 1937, that worked. 1950, it worked. But today, we don't want increases in inventory. That's not a building up of storehouse of value in the economy. That's, from transportation point of view, taking us further and further away from every point of consumption, leading to a pull of activity through the supply chain, right? I back it out. But that said, what it did was, the number in the first quarter was a percentage point higher, 3.1% instead of 2.1%, because inventories went up. Not consistent with shipment volume, but it's how it got reported, right? If I take out the export-import, all exports are positive, all imports are negative. Well, it depends on what you're exporting, and it depends on what you're importing. And when you're importing that Apple iPhone, and you're charging it in your calculation 800 something bucks, that's flawed. That's not true. If I back that out, then this number for GDP becomes 1.5%, which is much more consistent with this. And this suggests that second quarter may not be negative, but it will flirt with negative. And if this trend continues, third quarter will be negative. And if you have two negative GDP quarters in a row, it's called a recession. That's the definition. Those are the facts. This is the data. Of course, I love Ronald Reagan's definition. When he was running against Jimmy Carter, he claimed we were in a recession. And the GDP number came out, and the report was that the GDP had expanded by 0.1, 0.1%. And of course, Carter's folks went apoplectic. So, yeah, the old man doesn't know what he's talking about. He doesn't know what a recession is. Oh, he's a Donald old man. He used to be the actor. Now he's trying to be a politician. He doesn't even know what the definition of recession is. And God bless Ronald Reagan. They stuck a microphone in his face, and they said, Carter's folks say you don't know what you're talking about. Carter's like a submarine nuclear engineer. He's smarter than you. He says, you know what I'm talking about? Reagan said, no, I get it. I actually know exactly what a recession is. A recession is when your neighbor loses his job. A depression is when you lose your job. And a recovery will be when Jimmy Carter loses his job. And we need politicians and world leaders and government and corporate leaders and everyone else to have a sense of humor about themselves, because taking themselves so seriously is a bad idea. There's the data a little closer. You can see the point. So what's going on in more specific data? This is Long Beach, LA, inbound containers, largest container traffic in North America. It's a third of the total volume coming in. For us, it's 2/3 of the West Coast volume, and it does a great job of predicting consumer spending. The easy explanation as to why and how it does it is very simple. Well, you can't sell it if it's not on the shelf, and we have everything made in China anyway, so there it is. No, it's more complex than that. Here's what it is this is the reflection, the wisdom of crowds, the reflection of the activity of all the people who were buyers. If you're a buyer for Nordstrom of boots, a buyer of flat screen TVs for Best Buy, a buyer of whatever for Walmart, you're in that position. Why? Because over the years, that's your profession, you have learned how to figure out better than everyone else how many Tickle Me Elmo dolls the consumer was gonna buy and what the Tickle Me Elmo doll was gonna be. Some of them make mistakes, some of them get it exactly right, but collectively, they figure out pretty well. And right now, we're running negative. Would suggest that this holiday shopping season won't be as good as previous. European air freight and Asia Pacific air freight, down and down. And this is where we saw it first. It's why first FedEx and immediately thereafter XPO warned in the fourth quarter about looming softness. And it's one of the reasons why the European Central Bank has been cutting rates. And then we saw it follow in Asia Pacific. Here's what's happened in European air freight. You can see how it tracks the European PMI. So the purchasing managers, after it's showed up as air freight, will say, oh yeah, business isn't as good. And I've got clients who use this. Actually, it's not the only thing, but it's one of the inputs into their algorithm which they use to trade the euro versus dollar currency transactions, because this is a reflection of economic activity in Europe versus us and with us. Asia Pacific air freight, not everything we air freight in the Asia Pacific and Trans-Pacific region is a semiconductor, but hey, guess what? More than 70% of it has one or more semiconductors in it. That's why we had guys hedging, being short the semis. I have no idea whether it's Intel, AMD, NVIDIA. I don't know. That's not what I do. But I do know that there's a tight correlation between worldwide semiconductor billings and Asia-Pacific air freight numbers. And Asia-Pacific air freight numbers were down and continue to be down. And so lo and behold, they finally converged. That's not good for tech. And tech's a big, powerful part of our economy. Go back to that slide before. Want to know what's going on in the U.S. economy? What's going on in the tech economy? What's going on in the consumer economy? What's going on in the industrial economy? Make your assessment on those three and then make your assessment overall and ignore all of the fear. So if Asia Pacific air freight in general predicts semiconductors, what predicts Asia Pacific air freight? The answer is international inbound to Shanghai. So all those parts and pieces I talked about earlier that are shipped into China to be assembled to make iPhones and other types of things, iPhone just being a proxy for this coming through Shanghai. And when those numbers are down 15%, when you announce tariffs, by the way, tariff is a tax, and it's a terrible tax. Milton Friedman was the Mozart of economists, one of the most brilliant economists to ever walk the face of the earth, and a great sense of humor. He said some of the funniest things of all time. He said, if you put the federal government in charge of the Sahara Desert within 5 years, there'd be a shortage of sand. But what he also said in his book, his tome, the monetary history of the United States that goes from Civil War to present, he said that the 1929 recession would have been a garden variety recession had it not been for two things. One, the Federal Reserve allowed the money supply to contract when it should have allowed it to stay constant or even expand to be stimulative. At least the Federal Reserve of today, Bernanke, what do you think? Do you think I look like Bernanke? The beard, my kids keep me honest. They're like, no, Dad, you're more like Santa Claus. Thanks, guys. All the white. But Bernanke said, and the passage of the Smoot-Hawley tariff. The Smoot-Hawley tariffs destroyed the economy and led to the Great Depression. And tariffs are right now damaging our economy. They're a tax. And when you tax something, you get less of it. We passed a corporate tax cut, and we got a boom in the economy in 18. We're trying to impose ever-increasing tariffs and threatening to impose even more, and guess what? It's slowing the economy. Metal carloads, steel mill orders, down. And no big surprise, 9-week moving average down 3.3, 3-week moving average down 2.4. Not down dramatically, but down. Chemical shipments, this is my favorite. You can see the economic recovery, industrial-led economic recovery from 09 through 15. Why? You said, probably heard me say before. It's hard to make or assemble anything of any magnitude without consuming chemicals. So if you want to know what's going to happen with industrial economy, look at what's happening with chemical shipments. You can see the 2015 first 3 quarters of 16 recession, and then boom, you can see where we are now. Right now we're even. The last 3 weeks we're down 1%. We'll go too fast, sorry. This is chemicals overall. Construction materials. Guess what? Year to date, housing starts are down 5.3%, and year to date, construction materials shipped are down 5%. We're not building less houses because of the weather. We're building less houses because there's not the demand, because they haven't shipped the lumber. You couldn't build more houses if you tried. Now, don't have the lumber there. Auto carloads, same sort of thing. Year to date, auto sales are down 1%. Motor vehicles and auto parts shipped year to date are down 0.8%. Same difference. Can't sell the car if it's not on the lot. And so, all right, let's talk about trucking, which is more dear to everyone else. Okay, here's where this is FreightWave sonar data. This is the outbound tender volume index, which is everybody's loads being put out and offered, whether they're accepted or not by the carrier or by a broker or whomever. June levels were down 4.8% on a year-over-year basis, and as you all may probably know, June is one of the strongest, if not the strongest, freight month of the year. June, September, October are the 3 months of the year in which we see the most freight moved total, and the most freight we see moved in trucking. And in June, it was down 4.8% year over year. Last week, it was down 2.6. Real-time data tells us what? Economy's slowing. Outbound tender reject index, less and less. People are taking the load. You offering the load, I'll take the load. I'll move it. Part of this is technology. Part of this is I'm looking for loads. We built with DAT what we call our drive-in our barometers. What we did is really simple. We looked into their database, and we looked at all the loads being offered and all the loads being searched for, and said that activity and the ratio between those two activities is a proxy for what? Demand. And then we looked out at all of the trucks being offered and the trucks being searched for, and we looked at that activity and the ratio between those activities and said that's a proxy for what's happening with capacity. And then we went back and we back tested the math, and guess what? Those ratios, as you might expect, oscillate somewhat inversely from each other. And when they reach parity, when they reach equilibrium, that we set that mathematically to be 50. So it's really simple. It's like an ISM index. There's more loads than trucks. There's more trucks than loads. There's more loads than trucks, in part because the ELDs constrain capacity until people figured out how to use them. Now, normally, you would say government regulation imposed upon an industry makes it less efficient. And you would be right, except when the government regulation is to impose a regulation that requires the adoption of more technology by everybody, guess what? Technology makes the industry more efficient. So there was a learning curve, but after they got to the learning curve, they freed up the capacity. And on top of that, because we had high rates, people hiked driver pay, so fleets are fully seated, they bought more trucks, they bought newer trucks, and a new truck isn't in the shop as often, so it's more productive. That's all that's capacity, right? And so guess what? We got back to parity. We spiked up in June, and we're already falling back in July. And this is real-time weekly data. I just updated it. Why do you care? Because it does a great job historically of predicting that's going to happen in the spot market. Really? You sure? Yeah, I'm sure. There's the math. R squared is 0.8345, which means it's highly correlated. It's predictive. It explains a lot of what's going on. And as anybody in this room, I'm going to assume, knows, the magnitude and duration of the move in spot market tells you what the hell's going to happen with contract market. Said another way, if I have a big move up in spot and it stays up for a long time, contract's going to go up. If I have a small move down in spot and it doesn't last very long, it probably won't affect contract. The magnitude and duration of moves in spot price tell you what's going to happen in contract. This tells you what the barometer tells you what's going to happen in the spot price. Mathematically backtested, it's statistically significant and highly correlated. And the move in spot price tells you what's going to happen in contract. That's why you should pay attention to the DAT data. And self-serving bias admitted why you should listen to our barometer calculation. There's the difference between the contract and spot rate. This isn't sustainable. It's highly profitable if you're a broker, especially when it's doing this, but it's not sustainable. That's too big of a gap, and it's already begun to close. This is the reefer barometer. It's gone negative. After the June surge, it's gone back down below 50 in the most recent week. Flatbed the same way. We had a little bit of a June surge. Don't need to stand in front of it, but it's now fallen back negative. Both of those are bearish. I don't want to be bearish. I'm just telling you what the data says. So, 2017, December. Oh my God, ELDs, all the trucking companies, there's little guys that are cheating are going to go out of business. Oh, it's going to be horrible. Everybody knew it was coming. It's Y2K. Good friend of mine, A.G. Edwards, good friend to this day, walked around and he said, Y2K is not going to be a problem because calamity, well anticipated, seldom is. Everybody knew Y2K was happening, so they bought better computers, they upgraded software, they went in and they fixed it. And so guess what? Planes didn't fall out of the sky. You can still get cash out of the ATM on January the 2nd, January the 1st, 2000. Duh. Calamity well anticipated, seldom is. Everybody knew ELDs were coming. And so guess what? We did something about it. I already made that point. We miscalculated what the cheating was. I'm not saying that there weren't 1/10 of 1%, 2/10 of 1% drivers out there who were cheating by driving more than 11 hours. They're hopped up on amphetamines driving 14, 16 hours a day. But if the average age of a truck driver is 50, I can tell you as the owner of a 50-year-old body, you can't do that for very long without going hit and tilt, crash and having a heart attack, right? I mean, I could drink a lot of coffee for a day and I'm a hyper guy to begin with, but come on. The way they cheated was not that they drove more than 8 or 9 hours a day. They certainly didn't exceed 11. It's that they didn't drive the 8 or 9 hours or 6 hours or whatever that they drove that day. They didn't drive it within a 14-hour window. That's what happened. So they had a pre-plan. They had to figure it out. December 19 is not planned. December 19 eliminates grandfathered devices. It eliminates cell phone use to replicate. You have to have a device that's intrinsically integrated into the truck. That's a problem because nobody's planning for it. That's probably a little large, maybe more like 45% now. But a ton of the trucks out there still are not compliant in the Class 8 heavy duty market. They're still in the old, non-intrinsically integrated, old grandfathered. And some of it's Qualcomm and PeopleNet and whatever, real companies, right? They need to make that upgrade cycle. They just haven't. Not saying they won't, but everybody's sitting still not doing anything about it. And the requirement has been and always all the time that if you had a class 3 through 7 truck and you traveled more than 100 miles away from home, you had to have an ELD device. So what did they do? Well, you just download an app on your phone. We'll be fine. Don't worry about it. Now, I don't know what the number is. I'm going to guess it's around 10% of that population, 3.5+ million trucks, need to meet the requirement. But I'm going to tell you that more than 90% of them haven't done anything yet. And that's a big damn deal, especially if you're Amazon. Somebody like that trying to get that stuff delivered by all those small trucks. God bless Cottingham and Butler. When they make a mistake, it's a good one. So they printed up the slideshow, and the slideshow somehow has a couple of last year's slides at the very end. So you can double check that I'm being honest here, because the slides that you reproduced, it may have been my fault, were also two of the slides were my predictions. So these are my predictions for last year. Driving market stays incredibly tough. I was wrong. Well, I was right about the first part, but wrong about the second. Right about that. The problem with that is that's now an embedded cost. So as your spot prices fall and your contract prices are under threat, you can't go back to the driver and go, yeah, no one gave you a price increase. God, we love you. But that X cents per mile we gave you, we're gonna need a little bit of that back. That doesn't work. Can't do that, sorry. Big impact on visibility, even bigger impact on loading and unloading behavior. I get a bigger star for that because a lot of people thought I was ridiculous and wrong about that. The guy before us listed one of these reasons. Autonomous trucks are further away not because of the technology, not because we can't physically or technologically do it, it's because of socialization, it's because of hacking. He's right. I had someone hack our website. I think they were Russian. And literally 1,000 to 1,000 within less than an hour of us realizing that they had hacked and crashed our website, I had an extortion request for 50 grand. And I'm like, first of all, you don't know me. So you don't know that that's just not gonna happen, not gonna work, and goodbye. But that said, it's real. It's a real threat. Consolidation will continue because it makes sense. Capital is cheap, and there are opportunities to make things more efficient when you combine, especially if you're in the same silo. Wrong. I grow ever more worried about the threat of an economic contraction just because the data says so. Now, while I will tell you about all of the slides I showed you that show us dipping a little negative, is that I started worrying about the economy in mid-06, and things actually didn't start to get really bad until mid or late 07. And oh, by the way, at that time, being the snarky, smart aleck person I am, I would send our chief economist little emails about, oh, did you see what happened with unemployment? I was just driving around in my blue car, and I happened to notice. DOA, inflation, brand value of names continues to decline because you can be an iconic name today that was developed 40 years ago. It doesn't matter because new names come out of nowhere. It's amazing how fast technology allows us to build brand names. Biggest threat to economic security is trade war. And the Cubs were going to go another 100 years without winning a World Series. Okay, well, so far so good. I worry about the Democrats' ability to win because they're running against each other and he's already running for second term. Truckload pricing power of -2 to 1. Already made that point. Already made that point. I repeat that point. I repeat and stand there. I continue that. And yes, I continue to believe that's the case. Questions? Do we have any time? Q&A. Answers. Someone. Anyone? Anyone? Bueller.
When you were showing the dive, don't you think it's because people were stocking up beforehand because of our current maybe political situation? They were afraid of the tariffs coming in, so they bought a bunch of stuff, went way up. Now it's down. They're holding back. They got warehouse stockage. Maybe the tariff's going to go away. They're holding out.
Well, that is indeed a possibility that explains part of the final outcome. But here's the problem with that. If indeed that's what happened, and that's why GDP was 1% higher than it would have been without the inventories going up in the the first quarter, then the GDP growth rate in the first quarter wasn't 3.1, it was 2.1. And what it also signals is that there's not continued robust pull through. There's not continued robust sales at the consumption level. And so inventories rise. As I look through and I look in real time what's happening throughout the supply chain, the flatbed traffic, I don't get the sense that the rate of activity is doing anything but this. And so is inventory going up a result of early order trying to get ahead of it? I'm not saying it's not possible. Part of it might be, but the ongoing level of activity of loads being moved and sales at end are declining, which means it may take them a while to sell off that inventory that they pre-ordered to try to get ahead of tariffs. Does that make sense?
Yeah, I don't see unemployment softening though.
Unemployment's a lagging indicator. Unemployment's a lagging indicator. The last thing you do is let somebody go. It's a painful experience, even when they deserve to be fired. And I've fired people that deserve to be fired. I still feel bad about it. I felt bad about it, really bad about it that day. I still feel bad about it because I want them to be successful. I want them to be productive. Because I care about my fellow human being. So the last thing you do is let people go. And when you're on an economic upswing, you're blowing and growing, and you know you need to hire another person, but you can't find the right person, and you know that can you just work a little harder because until we get somebody else, please, can you stay an extra hour today? Unemployment is a lagging indicator. Always has been, always will be.
My last thing is, historically speaking, the year before an election year, which we're coming into, usually is a little bullish, sometimes stagnant at the very end, depending on if there's going to be a change. If there's no change, then it may kind of run like basically before Trump was coming in. You know, when it looked like Hillary was going to get elected, we were all stockpiling things, making bunkers, all kinds of stuff.
Well,
I'm not kidding. I took contracts on thinking she was going to
Donald Trump went to Wharton Business School, got an MBA from Wharton Business School. Arguably if not the best, one of the top 3, top 5 best MBA programs, business schools in the country. And never have I seen someone who has been so able to not let their education get in the way of their ignorance. He again and again says stuff that anybody who should even be considered to get accepted to their business school would know is buffoonery.
I'm just talking about the trend.
I understand.
Everybody's putting the brakes on now.
But my point being that any and every president will do any and everything they can to boost the economy going into an election because they know it helps their chances of winning. And so there's a pattern, and so the pattern you're referring to has had some merit. Jimmy Carter wasn't very good at it. We'll see about Donald Trump. There are presidents that are really good at it. Ronald Reagan was a master of it, you know. They did a lot of things to bump and boost 84 that helped him get reelected. And George the First didn't do a very good job, and lo and behold, Clinton and George W. did a phenomenal job of boosting results when they were running for re-election. So that pattern you're saying, pointing out, it does exist, but that's somewhat dependent upon the capability of the guy in that office to do that. And he does some things that I just don't understand. If you really did go to Wharton, you should know better, is my point.
I don't know. I'm a results-based guy.
Yeah. Yeah. Well, you tell me, are you seeing stronger volumes and stronger pricing right now in your business or not?
Yeah, but I'm a goofball. It's totally different for me.
Well, that's two of us. I'm a goofball as well. But the overall data is that volume in almost every single mode is slightly negative to.
In most niches, I think niches are hanging on really good right now. In any very niche business, the more niche, the more money in it.
So, like, give me an example.
I don't know. I mean, I supply plants. Most people don't do that. Most
You
people
supply what? I'm sorry, you what?
Plants.
Plants.
Stuff.
Okay, so you're in Colorado.
Not those kind of plants.
Oh, okay. Just checking. I can see you. I could understand why you were a little high, a little bit delusional about volumes, but whatever.
You know,
I'm teasing.
I understand.
Easy joke. But I mean, I'm green. Whatever. The point being that in total, if I look at the overall volume, and I'll tell you this, I'll admit this to you, that I showed you the data on CAS. I wasn't worried about an overall economic recession in 15 and 16 because the other volumes, even though the overall shipment index was down for CAS, there were plenty of overall volumes that were up. My concern is higher now, and it's not an absolute, but it's higher now because not only is the overall down, but I look at specific after specific after specific after specific, and the chemical volume and the metal and the steel volume and the auto volume and the housing volume make me less optimistic about the industrial economy. And the air freight volume, especially inbound to Shanghai, make me less optimistic about the technology economy. And that's been the bright spot for a very long time. It's been white hot. And the inbound into the container volume inbound, and the housing being slightly negative makes me less optimistic about the consumer. And it's in total that it just makes me more anxious. Does that make sense?
Yeah, the housing thing bugs me a little bit. But we haven't had a good hurricane lately either to rebuild.
Yeah. Well, the other thing I would tell you, though, is that the severity of recession, whatever the concern or the absolute is going to happen, it's not going to happen. Let's set that aside for a second. The severity of the recessions is dependent upon the excess that came before it. Recessions are God's way of saying, "Oh, that's right, I remembered." Oh, you greedy guy. When you get big excesses in economy, then when you do have a contraction, you have a big recession, a big contraction, because it's the market's cleaning it up. When you have a small excess and then you have a recession, it's more of a mild recession because there's just less excess to clean up. And in the industrial economy and in the consumer economy and even in the housing economy, I don't see that much excess. Maybe there's a little bit, but not a lot. Maybe in the Northern California and Seattle, there's excess in housing. The technology economy, there's some excess. But again, the depth of the recession and the contraction is dependent upon the amount of excess that needs to be cleaned up. And that makes me more sanguine, less anxious about the recession being severe, even if we get one. Does that make sense?
So you leave here today, what would you look for? What should you look for the rest of the year that might be predictive as to whether we're going to have a contraction, recession, etc.?
I would look at the DAT data, the DAT barometer data, and by mode to manage your business, because that tells you what you're going to see in spot and contract coming and what you're going to see in demand coming. I would look at the port data, inbound container, and the housing to tell me what's going to happen with the consumer. Auto is somewhat autocorrelated, if you'll excuse the pun. This is crazy. If you move, more than 50% of the sales at a Home Depot and a Lowe's are generated by people who are within 12 months of a housing change, because you fix the house up to sell it, and then when you buy it, you make it your wife takes it from being a house to her home that you get to live in, if you're a good boy. And the odds of you buying, trading your car, buying a new car, or trading your used car in for another newer used car, triple within the first 12 months of changing houses. So it drives a lot of activity. So I would look at the volumes of the container flows. I'd look at the housing. I'd look at, if I want to know what's going on with the industrial economy, just look up at chemical shipments, DAT. Those are the things I'd look at. And if you want to know what's going to happen with tech, keep looking at what's happening with the trade tariffs. There's a real economic impact. It's hurting China. That's actually, to go back to what we were talking about before, my biggest concern is that China has not had a recession in a very long time. And how much of their numbers are real, I don't know. I have no way of vetting it, except I know that they're getting crushed. When the inbound to Shanghai volumes are down 15%, that's not good. That's got to be creating some issues for them. And you're already seeing a rise in political unrest there that they can't seem to control. They can't seem to run any tanks over it. And they're the second largest economy in the world. They're the world's largest exporter. We're the world's second largest exporter, by the way. And we may go, at some point, surpass them again as we do more and more oil and gas exploration and start to export more oil and gas. Watch for that to happen. It has to get done, but the Chinese have zero incentive. They don't want to deal with Trump, because they are making a bet right now that whoever follows him will be easier, and they think there's a 50-50 or better chance that he's not going to be reelected. And so why shouldn't they just hang out and wait? One, say he gets reelected, he's still going to say, this is what I want, I'm adamant about it. And part of what he's talking about is real. The stealing of intellectual property, that's a real thing that we ought to address. But what's going on right now, raising tariffs are a tax. Raising tariffs on the Mexicans, and that's ridiculous. It's absolutely ridiculous. It's poor economic policy. It doesn't make any sense. I don't believe he showed up for class. It doesn't work. Mexico, 81% of their exports come to us. They're our third largest trading partner, only behind China and Canada. 74% of what they import comes from us. The more difficult you make that border to cross and do trade, the more likely you make two things. One, an economic recession in Mexico. And two, it's already happened, the rise of a leftist power in Mexico. Why? Because if you get more than 50 miles, especially more than 100 miles south of the border, the difference between, unless you're in a resort town, the difference between poverty and abject poverty in Mexico is whether or not you have any friends, relatives, family here sending money home. And if I make that border impossible to cross, I make it impossible for you to send money home, guess what? They're in abject poverty. And if they're in abject poverty, they have two things they can do. They're, what was it? They've nothing left to lose, right? There's John Baez. So what you do is you either join up with the drug gang or you vote for a leftist president who promises to give you something when you have nothing. So lo and behold, we have the rise of a leftist president in Mexico. It's not an accident. It's a result of the fact that the difference between poverty and abject poverty is the amount of money that's sent from here back there. And if it's not happening, guess what? So I worry about it because it's important. They're a neighbor country. We should be doing tons of trade. When they passed NAFTA in early 1994, what happened to truck tonnage? It was up 20% in 1994 because we made it much easier to get back and forth across the Canadian and Mexican border. And lo and behold, boom. Putting up tariffs is a bad idea.
Last question.
If the rise of road tax causes an increase in diesel price, wouldn't tariffs show an increase in inflation?
Oh, great question. I love this question. The short answer is yes. The long answer is no. Which reminds me of what Harry Truman said. Right at the end of World War II, there was a lot of concern. We now know that it was one of the greatest periods of economic prosperity of all time, a boom in the U.S. economy. But as we're bringing all the boys home from World War II, there was a lot of concern that how are we going to find jobs for all these guys we just destroyed a lot of the countries that had great economies that we were trading partners and exporters to. We could have a real, this got us out of the Great Depression. We could go right back into it. So they had economists after economists come in and talk to Harry. And they kept saying things like, well, you know, on one hand, this could happen, but on the other hand, this could happen. And so Harry, being a Missourian, fellow Missourian and a straightforward straight shooter, said, can somebody bring me a GD one-handed economist? So I understand that, one hand to the other. Short term, the answer is yes. It will put a lot of pressure. It already is putting some pressure on inflation. The long answer is no. Because what technology does is it gives us so much price visibility that it allows us to say, well, if I can't do it there, I can do it here. I know guys who are already creatively avoiding the Chinese tariffs because they're shipping containers from China to countries in South America and elsewhere, and then shipping those containers here. Will they eventually get caught? Yeah, maybe, probably. But in the interim, they're avoiding it. It enhances that kind of behavior. We are stealing manufacturing jobs today from Vietnam because it doesn't matter, or in China and elsewhere, because there aren't any. There's an article tomorrow, or actually it's right now on Friday, it just got released at 3 o'clock, about inflation that I wrote. 20 years ago, I went to a Caterpillar engine plant, watching them make Class 8 heavy-duty, big diesel engines. And the plant floor had as many people on it as I see out in front of me right now, and they're all smoking cigarettes and talking about the football game and talking about when beer 30 is and what, blah, 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 and they're doing this. Oh, yeah, no, I don't know. I don't think the Eagles have chances here. Right? You go to, I recently toured a PACCAR engine plant down in Mississippi. There's not a single person on the floor. It's machines making machines. And if there is no labor on the plant floor, it doesn't matter what the cost of the labor is. And that's the American technology miracle that we're putting into manufacturing. So what may happen is that initially it may boost inflation, but technology will see that pricing and use it as a methodology to invest in automated production and assembly and eliminate the labor. And so it goes back down. It may effectively do exactly what he's trying to do, which is bring the jobs back here, but it will be a job. It'll be the manufacturing process back here, but it'll be bringing the manufacturing process back here, and this job still won't exist because the technology will have destroyed the job, and in which case there's no inflationary pressure. Does that make sense? Did I answer the question? Okay. So initially, yes. Midterm, long-term, no. Thank you so much. I always enjoy presenting to you.